I'm Kramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate, teach, and put days like this in context.
Welcome back, friends, for one more inside update from the world of EV stocks. Before we begin, we have noticed that still only a small percentage of our viewers are actually subscribed to our channel. So, if you are not yet subscribed, we would request you to subscribe to us so that you don't miss any of our future updates on the Tesla, or NIO, or XPeng stocks. Now let us get started. In our video from yesterday, we already dissected the near-term technical chart of NIO, and showed where the immediate support and resistance levels are. We also mentioned that the bond market activities were mainly behind the crash in the growth stocks. Now, today, in this video, let us try to understand what exactly is going on wrong at the bond markets. The main problem we are facing is that the yield in 10-year and 5-year Treasury bonds have moved up significantly. Whenever these yields in the bonds go up beyond a certain point, it usually spells trouble for the growth stocks. Let us understand why that is so. Investors generally invest in the stock market because here is where the yield will be far more than in safe assets such as bonds. However, if the bond yields start rising, and rise beyond a certain point, the attractiveness of stocks go down. Bonds are considered 100% safe, whereas stocks come with their inherent risks. So, why invest in risky stocks if bonds start to look more, or at least equally attractive? That is the primary market force that is causing the current crash. Now, you may ask, why is that suddenly these Treasury bond yields rising now? In short, bond yields are rising because nobody wants to buy the bonds right now. And that is happening mainly due to two reasons. Number one, fiscal stimulus. Government borrowing to finance fiscal stimulus is done primarily through issuance of more Treasury bonds. Hence, it's expected that Treasury bonds will face dilution in value soon as we get massive government stimulus from the Biden government, and as a result, people are avoiding buying into these bonds for now, as they think the bonds will be much cheaper later on. Number two, fear of inflation. There is some expectation of inflation returning, as US economy makes a sharp recovery in 2021 and 2022. Now, higher inflation will lead to higher Treasury bond yields. So, it's making the Treasury bonds unattractive at their current yield at the moment, causing less people wanting to buy the bonds now.
What's happening here with the expectation that the 10-year may continue to go up, how much farther do we have to go down?
So, I think what's interesting is that I think what Needham is saying is that the equity market sell-off is about chasing yield, which is we have a battle going on between equities and the bond market, because today dividend yields for equities are 1.51% and the dividend and the bond yield is now 1.55%. By the way, just 6 months ago, the equity dividend yield was 3 times higher than the 10-year yield, and the 10-year bond yield. And so what worries me is there's a lot of passive money out there that's been growing over the last 5 years as bond yields continue to decline. And I worry that we don't know what's in those algorithms in terms of asset allocation. So I worry this kind of volatility is going to continue to be a curse of the equity markets now going forward as bond yields rise.
Okay, but let's just play this out, and let's play it for long-term investing, not GameStop today and tomorrow.
Okay.
Do you look at these dips, if you will? Is this a buy the dip situation or not?
So for big tech, I absolutely think it is. I think these stocks are defensive. If you look at my screen, everything's down more than 2% except big tech, because it's hard for big tech to go down 2% because they're trillion-dollar companies. So I like them as a defensive play. Obviously, sometimes like Amazon's been dead money for 6 months because it's a source of money for the reopen trade, because Amazon was such a big beneficiary of COVID that people are selling that one to buy reopen trade kind of names. But no, I like them defensively because they're globally scaled. They are monopolies in the businesses they each created, and they are and they have pricing power. So no, we like them, and they're liquid. So we really like the big tech for those defensive reasons.
Right. I'm sure management doesn't like you calling them monopolies, but investors do.
Hey, I'm Kramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate, teach, and put days like this in context, because I know you care and are concerned. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. It was a tough day. I'm talking about a really tough day. I mean, the averages, they were annihilated, all right? Dow plummeting 560 points. S&P plunging 2.45%. And the NASDAQ, sell. Nosediving 3.52%. All for one reason only. Interest rates are soaring. Why? Because the bond market sees the economy getting ready to reopen. Yes, the vaccine. And it figures the last thing we need is more stimulus. To these bond investors, you know what that's like? It's like throwing gasoline on the Kingsfords. They think the economy will overheat, and what happens then? We are going to get some serious inflation.
The House of Pain.
Right now, we have a Fed chief, Jay Powell, big heart, who thinks it's nuts to worry about inflation because so many people are out of work because of the pandemic. So he doesn't want to raise rates, especially since inflation has been so low for so long. Hey, look, is he looking at lumber doubling? Like, if you want to do that, okay. Copper 417, maybe. President Biden and his allies in Congress want to pass a huge stimulus package because they want to breathe new life into the economy. As I see it, Powell and Biden are doing the right thing. I don't mind a little inflation now and then, but to bond market investors, they're thinking, are you nuts? The economy's about to start booming thanks to the vaccines, and most consumers are in great shape. Everyone except the people who don't have a job. Unfortunately, there are a lot of people who don't have jobs. As a result, investors are selling bonds, pushing long-term interest rates higher, pushing your mortgage rate higher if you have an ARM. Just checked that this morning. When that happens, stock buyers pull back. They always do. And they pull back hardest on the highest growth stocks, the ones we like the most in Cramerica, but we recognize do get hit in this moment. And that's what happens. That's the high price of inflation. That's what went on today. Case in point. NVIDIA. Last night, this company reported the strongest quarter I have ever seen from NVIDIA. This company's become the dominant player in the semiconductor space like Intel was in the 90s. No one is coming close to them. Whether data center, it is gaming, it's artificial intelligence. Yet the stock got crushed because this is exactly the kind of turbocharged growth story that Wall Street turns against when rates are rising. Now, I think NVIDIA is a victim of short-term thinking. The people who dumped it here, I think, are going to be making a mistake, including the ones who are going to dump it tomorrow. They haven't thought it through.
Now, coming back to NIO, it's important to remember that the fundamentals have not changed even slightly, and there is absolutely no reason to sell even a single share of NIO just because the whole market is going through a temporary correction mode. As always, thanks for tuning into this update. And if you haven't yet watched our beautiful compilation video on the NIO CEO Lee Bin explaining the big future visions of NIO to the Western media, please do check out the video from the link on your screen now.